This combined meeting of the Finance and Member Services Committee and the Defined Contribution Committee is going to be recorded and now is being recorded for record-keeping purposes. By participating in the session, you are consenting to the recording, retention, and future viewing of this meeting. The meeting is now being live-streamed.
Okay, thank you, Don. So just before we get started and call the meetings to order, I just wanted to give everyone just an overview of how these meetings are set up because we don't normally do joint meetings. So the agendas for the Finance and Member Services Committee and the Defined Contribution Committee run parallel. There were board docs meetings set up for both committees, and they both run parallel as well. They both have material in them. The only difference is that the potential motions are only in the Finance and Member Services Committee because they'll be taking any potential action based on their charter. For live streaming purposes, we'll be in the Finance and Member Services Committee. And I think, we'll just go through as best we can. There'll be 2 reports at the end, and Mary will be giving them at the board meeting that follows these committee meetings. Did I miss anything, Mary?
I think that covers it, so let's begin. So I'd like to welcome everyone to the joint meeting of the Finance and Member Services Committee meeting and the Defined Contribution Committee. It is approximately 1:08 on March 25th, 2021. So let us begin with the roll call of the Finance and Member Services Committee. Sarah, will you take the roll call, please?
Sure. Senator DeSanto?
Chuck Erdman here for Senator DeSanto.
Okay, thank you. Chairman Philman?
Yes, here.
Representative Frankel?
Here.
Committee Chair Soderberg?
Here.
Secretary Vague? I think Alan's here on behalf of Secretary Vague.
Alan?
Hi, this is Jim Bloom. I'll sit in the chair until Alan gets back. I don't know where he is.
Okay. Thank you.
Thank you, Jim.
Okay. Everyone's present for the Finance Committee.
Very good. And Joe Torta, would you do the roll call for the Defined Contribution Committee, please?
Absolutely. Mr. Erdman, on behalf of Senator DeSanto.
Here.
Representative Frankel.
Here.
Representative Schemmel.
Here.
And Committee Chair Soderberg.
Here.
Thank you.
Okay. We have, next order of business is approval of minutes, and we have no prior committee meeting minutes to approve. We have no old business. The first business for the day is a special presentation by our Callan, our consultant. Tom Schindler is going to do a presentation on analysis that their company has done on defined contribution and deferred compensation investment option fees. So, Tom?
Thank you, Chair Soderberg. I'm going to turn it over to my colleague, Britt Murdoch. Britt's going to go through our presentation evaluating the investment management fees. So after this, just to clarify, presentation on the plan administration fees, this is solely about investment management fees. Britt?
Thanks, Tom. If we could turn ahead to the next slide, just to provide an overview of the analysis. Thank you. So, as many of you are aware, quarterly, Callan presents our performance to the investment committee, as well as reviewing investment option fees within both the 457 and the 401A plans. Every few years, we want to take a deeper dive into the fees within the plans. And in this case, we're solely focusing on the investment manager fees and how they compare to peers. It's important to know that in our comparison, we really tried to make sure we're making apples to apples comparisons. So For large cap U.S. equity funds, we are comparing them to other large cap U.S. equity funds. For passively managed funds, which most of the investment options within the two plans are passive, we make sure that we only compare them to the passive peers in the universe. And finally, we make sure the investment vehicle types are the same. So for the 457 and 401A plans, most of the investment options are commingled vehicles or collective investment trusts. So in those cases, we compare them to other commingled investment vehicles in the peer universe. And the same thing applies to separate accounts. Are there any questions before we touch on a summary of the analysis? Great. If we could turn ahead to slide 3. So here, I know it's a little difficult to read on the screen, but we lay out all of the investment options within both the 457B and the 401A plans. You can see on the left, from the target date funds at the top, stable value fund, the various individual investment options, and finally the brokerage window. In addition, we list the vehicle type and the combined assets, which we use to really evaluate the peer universe in terms of the broad scope of how many assets are invested with that particular investment option. In the third column, we list the investment fees as a percentage and the dollar amount in the column next to it. And importantly, you can see we list the peer group median fees on the far right. And what we're looking here is we want to make sure that all of the investment options offered within the two plans are competitive relative to peers. And if you go through, each investment option is well below the peer median, which is great. And in many cases, it's significantly lower than the peer group median. I'll pause there. I think the following pages get more into detail within each investment option's peer group and their individual ranking. Fees are very competitive on the investment management level across the board. And we don't recommend any changes or any further steps at this point, and we'll continue to monitor fees going forward. So with that, I'll pause and see if there are any questions. Great, thank you.
Okay, that concludes that presentation, Chair Soderberg, so we can move on from here unless there are any questions.
Okay, thank you very much. I'd like to turn it over before we begin our new business section under number 6. I'd like to turn over to Chris Houston, who's our Deputy Executive Director, and just for him to discuss the conflict of interest situation.
Yes, thank you, Mary. So in my capacity as Acting Chief Compliance Officer, I had previously provided information to the board regarding how conflicts of interest were addressed for CSRS attorneys and other staff who have been engaged in the analysis, research, and development of recommendations pertaining to the fee discussion you're going to be having relative to both the 457, the Deferred Compensation Plan, and the 401A, the Defined Contribution Plan. There were conflict disclosures which were provided by attorneys and pertinent staff that have been engaged in this process, and that was given pursuant to the board-approved and adopted Employees Code of Conduct. And also for attorneys, notice was given pursuant to the rules of professional responsibility. I wish to point out that in drafting the Code of Conduct, it was specifically contemplated that staff could be engaged in matters which may have an impact upon them personally, so long as it applied generally, that same impact applied generally to the class of participants of which they are members. And we're talking here specifically about there being members of either the DCP or DC plan, or perhaps both plans. So that's the issue of the conflict. The Code of Conduct says that they can continue to work on these matters as long as they provide notice and disclosure. And all employees that I'm speaking about here did provide the notice and disclosure. Appropriate waivers of any conflicts were provided. And I also wish to point out that these conflicts which were raised are not conflicts under the Pennsylvania Public Official and Employees Ethics Act, nor are they standards in violation of any prohibited conduct under the Governance Code of Conduct. So I just wanted to point that out, that this was the how we handle the disclosures, and I'd be happy to answer any questions of any board members relative to that, if you have any.
Thank you, Chris. Are there any questions? All right.
Thank you.
Thank you. So we've got a lot of material we're going to cover today, and it's complicated, and it's even further complicated because we're dealing with two different plans that have very similar names: the Defined Contribution Plan, which is relatively new, and the Deferred Compensation Plan that SERS has been managing since the late 80s, I believe. Anyway, Sarah McSurdy is going to run through the PowerPoint that is on our agenda under New Business 6A, and it is quite likely that we will break several times within this presentation to go into executive session. So, Sarah?
Okay, thank you, Mary. So, like Mary said, this is agenda topic 6A, Defined Contribution Plan, Fees and Expenses. And this will also cover agenda topic 6B, Deferred Compensation Plan, Fees and Expenses. There's one large PowerPoint presentation that covers both agenda topics, and it's filed under agenda topic 6A. So if you can go to the next slide. As Mary mentioned, this is there's a lot of information to cover, and this presentation is larger than what's normally given in any of these meetings. So I just wanted to give everyone an overview of the presentation plan. First, I'll provide some background of the two plans that we'll be concentrating on today, and then I'll give an overview of an expense analysis and reductions that occurred during 2020. Then we'll go into the Defined Contribution Plan, Fees, Expenses, and Funding, where we'll focus on third-party administration fees. As Mary mentioned, there's an executive session that we'll have, and then there's possible motions. After that, we'll jump into the Deferred Compensation Plan, Fees, Expenses, and Funding, where we'll concentrate on plan administration fees. And similar, we'll go into an executive session, and there will be possible motions. After that, we'll talk about any next steps that may arise. I'll stop throughout for questions, but also feel free to raise your hand if you have one as we're going through. And I also want to mention that our friends from Callan will be here, and they'll co-present certain slides with me. And then we also have John Fellon from Empower, who should be in this meeting, and he will be available to answer any questions that you would have for him. So if you could go to the next slide, and then to the next one. So as Mary mentioned, we'll be talking about two plans, and they sound very similar. They do have some commonalities, but they also have some differences. Some key points I want to note in the chart for the Deferred Compensation Plan in the left-hand column. Concentrate on the fact that this is a voluntary plan, and as Mary mentioned, we've been operating this plan since the late 1980s. The Defined Contribution Plan on the right-hand side is a newer plan, and we've just been operating that plan since 2019, and it's a mandatory plan as that was required under Act 5, and this is part of a mandatory hybrid benefit or a standalone benefit that new members of the system have to be in. So if you could go to the next slide. As I just mentioned, the Defined Contribution Plan is still in its infancy stage, and it was implemented in a very short amount of time. So as a refresher, Act 5 was signed into law in June 2017 with an implementation date of January 1st, 2019. which was a very short amount of time to have the plan ready. After receiving initial funding in February 2018, in just 10 months, CSRS accomplished the following. We interpreted the Act to make sure that we were operating in accordance with it. We worked with investment consultants to develop investment option choices, hire managers, negotiate favorable fees that Kellen just touched on. We issued a request for proposal to hire a third-party administrator. Empower was then hired in June of 2018, which left just 6 months to build the entire defined contribution plan on their platform and develop educational materials specific to CSRS administered plan and reflecting the CSRS brand. We incorporated changes into our new member communications because this hybrid or standalone defined contribution structure is fundamentally different than the traditional defined benefit we offered before Act 5. We communicated plan changes to our employers, we provided webinar trainings to them, and we issued guidance on making payroll changes that they needed to make to their platform. We also implemented system changes to accept and warehouse defined contribution plan transaction data in our CSRS system, while sending applicable data to empower our TPA. Processes were also developed to reconcile transactions and contribute receipts for employers. This is to best ensure the completeness and accuracy and consistency in the contributions being withheld and invested. And we feel that this is a very strong process that we deploy. We also worked with external tax counsel and created the state employees defined contribution plan and trust document. If you go to the next slide. The funding and cash flow to cover fees, costs, and expenses varies by plan, and we'll cover that more in each individual section. But the fees, costs, and expenses of running the plans are similar. They both have investment management fees. These are costs to have an account invested. They both have third-party administrator fees or TPA fees. Generally, these are costs to have Empower administer the plans. They also have other administrative expenses, which are CSRS as plan administrator, the expenses that we incur in running the plans. Such costs include salary expense, investment consultant expense, auditor costs. And I'd just like to note that for the third-party administrator and any other applicable vendor, we do issue RFPs in order to get the best quality service and competitive pricing. If you go to the next slide. Just to talk a little bit more about salary, staff from across CSRS bureaus spend time to keep these plans running in a timely and efficient manner. Some key duties are covered on the following slides. You go to the next slide. Some value-add key duties that we have are ensuring compliance with the governing documents, taking an active involvement in making sure that the participants are getting the best quality service that they need over the next couple of bullets, which include advising the TPA regarding current issues, future strategic direction, and CSRS perspective on participant needs, monitoring and review of participant behavior, investment performance, and effective operations, developing, editing, and delivering educational or informational materials to our participants, employers, plan sponsors, and other stakeholders, and then responding to basic participant inquiries regarding available plan options. We also collaborate with the TPA field office staff and call center staff on customer service issues to determine resolutions. And the one bullet I did miss is staff here also provide support to the Finance and Member Services Committee and Defined Contribution Committee, which we're all here today discussing issues involving both of these plans. So jumping back down to that last bullet, we also coordinate investment research, making recommendations on investment options and enhancements, and also performing initial and ongoing due diligence. You go to the next slide. For the defined contribution plan, as I mentioned before, we accept participant personnel and payroll transactions submitted by our employers on their data feeds. storing the information on our Cirrus benefit processing system and transferring applicable data to our third-party administrator for entry into our system. This is a very good control that we have, which is reconciling transactional data and payments, and we research and fix issues. We act as a central hub between employers and our third-party administrator, and we feel like this is the best model for completeness, accuracy, and consistency. We accept contribution payments, including rollovers that are then processed through the PA Department of Revenue and Treasury. We process outgoing rollovers and distribution payments through Treasury. We reconcile daily investment purchases, sales, and other activity, which could include participant changes in investment option choices with the Pennsylvania Treasury and the third-party administrator. We also answer employer questions regarding reporting or payment. We produce monthly statement of changes, which is presented to the CIRS board for review. And then last but not least, we perform internal audit review of internal controls, and our internal audit department coordinates the performance of an annual external independent audit. So you can go to the next slide and the next one. So as I mentioned, the defined contribution plan was implemented in an expedited time frame. So as the defined contribution plan becomes more established, cost savings initiatives are taking place, with the effort being expanded to the more mature deferred compensation plan where possible. During 2020, staff examined internal and external processes to find efficiencies and see where costs could be reduced and/or services improved. It's important to note that the work on this important initiative will continue into the future because we're always trying to seek improvements. The ultimate goal is to develop better budgets that will be indicative of the ongoing costs to run the plans going forward and to evaluate any opportunities to reduce costs. We also wanted to make sure we examine all costs before making the presentation on fees and expenses that we'll be making today. Key accomplishments and potential savings are noted on the following slides. You can go to the next slide. So we evaluated personnel costs, which included reviewing the current complement behind personnel expenses and allocation of staff time. The bureaus looked at actual and projected costs, and we compiled salary amounts that are going to be used in the deferred compensation budget. We think this will produce a couple $100,000 in savings in the defined contribution plan budget. If you go to the next slide, I'm going to turn this over to Joe Torta to discuss this slide of accomplishments.
Thank you, Sarah. Very briefly, we evaluated the $59.50 annual TPA fee, which is the fee. It's the cost for Empower to administer the deferred compensation plan. First and foremost, any changes that are proposed and any fee savings that are discussed and agreed upon are with the caveat that no service reduction will be tolerated for members and participants. If I sound like a broken record, I apologize, but that's where my agenda starts and ends. We're looking at a reduction of the $59.50 annual fee effective 7/1 of this year down to $55.80, which is a significant decrease, and then an additional reduction down to $53.40 by 7/1 of next year, 2022. Overall, over a 12-month period, that will represent a 10% overall reduction in annual TPA fees. The hope is that this is only the first step in a longer-term review, and that over the next 18 to 24 months through automation, we might realize some additional savings. One thing, the virtual world that we're all operating in even today right now, is that there's a more cost-effective way of doing business, and we're looking at all of those things. Thanks, Sarah.
Okay, thanks, Joe. If you go to the next slide. And then we also evaluated our processes with the Pennsylvania Treasury, which is our custodian and our TPA. We had a paper check distribution process where we had paper checks changing hands and being printed at Treasury and then coming to CSRS, and we had to have a manual process where we would stuff them into envelopes and send them out to our participants. And we were able to come up with some changes throughout this year to move that process to be totally at Treasury, so they're able to receive our files, produce our checks, and send them out directly without CSRS having to be involved any longer, which was a Band-Aid process because ultimately we want to move to converting a lot of those disbursement checks to ACH. We also want to convert incoming contribution checks to ACH. Then we also want to look at some moving from paper to electronic forms for our participants, and then also some ongoing exploration of additional opportunities to improve the participant experience, streamline administrative processes, cut costs, and reduce risks. So you go to the next slide. So I'm going to stop there and pause for any questions before we jump into the defined contribution plan. Okay, seeing none. If you can move to the next slide then. The first item I'm going to cover, which has evolved and is somewhat complex, is sources of funding for the defined contribution plan since the passage of Act 5. The CSRS code currently identifies 6 funding sources to cover administrative costs. The first 3 are required: employer contributions and investment earnings resulting from pension forfeitures. These are not very likely to occur, and I don't think we've had any since the plan has opened. The float or interest on participant contributions before they are invested. These contributions really only sit for a very short amount of time, so that amount of money is also immaterial. And then this amount is substantial, and this is very important: the forfeitures of non-vested employer contributions and investment earnings. And this source was not there at the very beginning, but Act 2020-94, which was enacted on October 29th, 2020, allows us to retain these unvested employer contributions. Before that, employers were able to use these to offset future contributions to the plan. It's estimated that these forfeitures will be about $1.1 million per year, and we expect them to grow as the plan grows and people terminate closer to the 3-year vesting mark. The bottom 3 are optional sources, which include assessments against participant accounts, additional direct appropriations by the General Assembly from other funding sources, and this is important to note, that's at their discretion. The General Assembly was, however, required to provide funding through June 30th, 2020. And then there's the per participant charge that's currently assessed to employers. This was enacted through Act 2020-23 in May of 2020, and that authorizes CSRS board to assess this charge. The board approved that in July of 2020, and that's currently how we're receiving our funding for this current fiscal year. So you can go to the next slide. The next thing we'll talk about are expenses. The defined contribution plan has investment management fees, which are paid by participants. There's also the third-party administrator fee on all active and terminated accounts. And then there's other administrative expenses, which I spoke about before. This slide just shows a little bit about our budget for the current year and some previous years, splitting out since we're going to be focusing on the third-party administrator fee today, just showing what portion of the total budget that third-party administrator fee is. One important thing we want to note is at the very beginning of Act 5, we did receive funding in 2017-2018, which, as I went through before, in the expedited fashion of having to implement the Act, we did receive funding and refund about $5 million back to the general fund. If you could go to the next slide. So the costs that remain after all required sources of funding that I covered on the previous slide will be assessed to employers through the per participant charge. This slide shows that, if you could go to the next slide. This slide shows the effect of the 2020 funding changes that I just discussed and the cost savings initiatives on the per participant charge to employers. You can see our original fiscal year 2021 budget for the upcoming second year charge was originally about $4.4 million. With the new unvested employer contributions that we're allowed to use as a cash flow to fund those expenses, we're able to reduce that by about 1.1 million. And then the other reductions reduce it by another 300,000. So the revised 21-22 cost to cover is about $3 million compared to the cost to cover than the prior year, which was about 4.5. We're really reducing that by about 1.6. So currently, based on the current cost to cover of $3 million and the membership, we're currently estimating that the per participant charge will drop to about $292.90 compared to last year, which was the first inaugural year of the charge of $668.77. But what's important to note is that although the per participant charge is estimated to decline, the total employer cost will grow as the participation grows. So if you can go to the next slide. So as mentioned, the retirement code does provide the board with an option of charging all or a portion of the administrative fees to defined contribution participants. It's one of the optional funding sources. So after 2 years of operations, CERS staff felt it was important to present to the board for its consideration several scenarios to demonstrate the impact of charging participants various portions of the TPA fee only, not the full administrative cost or budget of the plan that I just went over on the previous slide. And we just want to see if the board has any desire to exercise this option at this time. In making this determination, consideration should be given to both statutory authority and fiduciary obligations. As such, we're going to give you the opportunity to go into executive session. I'm going to turn it over to Kathy Nolan, counsel to the committee, to make the announcement.
And thank you, Sarah. Good afternoon. We're going to be going into executive session now, as Sarah just said. Under the Sunshine Act, the board is permitted to hold an executive session for any of 7 reasons listed in the statute. The topic of this executive session is fees of the defined contribution plan. The Chief Counsel's Office will be advising the board on statutory requirements for those fees and related legal issues, and therefore holding this discussion in public would disclose attorney-client privileged information, and that's the reason the Sunshine Act permits this discussion to be held in executive session. Thank you.
Before we enter into
So is it okay for me to start now? Or do we need additional
Usually Dawn gives us a verbal, because it takes a second after we hear that recording, usually a second or two.
Okay.
Maybe, 40.
Well, it's okay. We need...
Okay. This is the joint meeting of the Finance and Member Services Committee and the Defined Contribution Committee. We are now out of executive session. Sarah, do you want to proceed with the slide presentation?
Sure. Can you move to slide 21? Thank you. So just continuing on to talk about the analysis that we went through. CSRS, Kellen, and Empower have worked together on an important analysis on the third-party administrator fee and the defined contribution plan. A primer was given at the February CSRS committee meetings, and then Kellen presented at a CSRS board education session in February. Kellen will now present the outcome of their analysis, and I do know they were not in the executive session, so we'll just have to make sure that they're, back into this public meeting. We might have to give them a second.
I've been monitoring for you, Sarah. Yet. We got Empower on. There's the. What is the next slide, Sarah? There's Tom. I see Tom. I guess we're waiting for Ben.
Hi, Terry. Hi. We're just trying to get back in. Ben, are you in that?
Yes, sir.
Oh, very good.
Great. So Ben's going to tag team on the Callan section. And for those who don't know Ben Taylor, Ben is head of tax-exempt defined contribution plan research at Callan. So what that means is he works with government plans and nonprofits like universities on their defined contribution plans. He works with a number of large state plans. Has very relevant experience for this situation at CSRS, and also is past president of NAGSA, the National Government Defined Contribution Association. So he can bring that experience from NAGSA as well. So Ben's going to cover this year. Ben, I'll turn it over to you.
Thank you, Tom, and thank you for the kind introduction, and hello, everyone. Nice to make your initial acquaintance for those I haven't spoken with in the past. I'm going to be brief on the initial piece here, just setting some context to get into the numbers, and then let Tom discuss some of those key items and illustrations for the 401A plan. So with respect to the fees that we're discussing today, this is just laying the groundwork for what it is that we're covering. Sorry, I hear some feedback. I know someone needs to mute there. So on the left, we have the different the center, we have all the different categories of fees that we could be covering. On the left is what we're going to be covering today, which is plan level administration fees. So it's distinct from transaction fees like a loan fee or investment management fees, which were covered earlier by my colleague Britt Murdoch, or other revenues such as those that might arise from managed account services. All are relevant for fee due diligence, but we're just talking about raising plan level administration fees here to cover the costs that Sarah Mix already discussed earlier. Next slide, please. This is from one of our annual surveys of clients. This is a survey that represents about $100 billion in defined contribution plan assets. I won't ask you to read all the tiny print, particularly if you're looking at this projected. But the key thing I want to highlight is what's on the bottom of the slide in the graphic that you see in the kind of aqua blue there. So it's how do participants pay for plan administration? This is just a measure of prevalence for different fee models. If you look carefully, you can see that revenue sharing or that direct fee from investment managers is about 12%. 75% of plans, and this survey is biased towards very large plans such as a CSRS, have an explicit per participant dollar fee, and then there's another 23% that have an explicit asset-based fee. You can see that sums to a little bit more than 100%, which is kind of presaging some of our later comments through the course of this meeting, because there are various combinations of them that are occasionally present, because it is a mechanism by which you can spread the incidence of fees across participants of different balances and experience within the plan. Next slide, please. So just to set the table for what our challenge was before analyzing various fee structures, the 401A plan is, as Sarah discussed earlier, quite new, having started only in early 2019. As a startup plan, you're going to tend to have a lot more growth initially in the rate of new accounts, particularly for a mandatory plan such as this, than you're going to have for assets. Assets will take time to accumulate, and then over time, that will switch. But at the present time, we're seeing a rapid rate on a percentage basis of growth in accounts relative to assets. And that has certain dynamic implications for what fee structures you're able to accommodate in terms of how it will impact participants and what revenue will generate. So you can see the bottom quartile balance of the 25th percentile balance at that point. Not the average of that quartile, but the point measurement for that quartile is a $329 balance in that plan at the present time. And these data are as of the data that are provided to us from Empower when we conducted the analysis, so this was later January. The median balance, a little over $1,000. Top quartile balance, just under $2,200. Average balance, just over $1,900. So why are we talking about these different balances to set the table? It's mostly because of the fact that if you have a low dispersion between the quartiles, certain types of fees, and looking at those different mechanisms for measurement and raising of revenue are less impactful. If you have an asset-based charge and you're ranging from a median balance of 1,000 to a top quartile balance of 2,200, an asset-based fee variation is not going to change very much in terms of the revenue that's generated. So the next slide, please. So our objective here was to find different ways to pay the TPA fee in this analysis. We looked at a number of different types of fee structures, and when we looked at each of them, we looked at a couple of different factors, as it says here on the slide. How much revenue will it generate, but also how much is this assessment of fee as a percentage of assets by both subgroup and percentile rank for balances. So we're trying to get a sense of the differential impact of people at the various stages of interaction with this plan, especially, again, given it's so new. We're also looking at how many accounts will experience a shortfall. We don't want to have a fee that is put in place that wipes out an account that is fairly new, for example, or has a low balance, or potentially also what it will do to inactive accounts that have low balances for those who've separated from service. We did account for terminated employee accounts in our analysis, both from a cost standpoint as well as from those factors I mentioned earlier, in particular those that would have accounts wiped out if they had short tenure. The types of structures that we considered, we had first a fixed flat fee, so this would be a direct assessment split over an interval where you would just charge a specific amount irrespective of the amount of assets that are present in the account. Alternatively, and very differently, an asset-based fee, just a direct percentage of assets, for example, 10 basis points or 1% of plan assets, irrespective of any other factor. We could look at a hybrid fee, which is a combination of a fixed fee component with an asset-based fee component, which is typically looked to both reduce the volatility of revenue generated from a strictly asset-based fee, but also to have kind of various equity implications if you're trying to impact the incidence of those fees on the participant account so that you're not disproportionately impacting one or another group. And then lastly, hybrid fees with constraints. So that would be a constraint such as a floor or a cap to the fees, such that you would not charge fees beyond those boundaries. Ultimately, due to the low balances here, this is a fairly simplified analysis. You can see that the asset-based and hybrid fees and the bounded fees were not deemed to be very viable or to really move the needle that much with respect to the total cost incidence associated with each of those structures. So the most viable that we determined jointly with staff and with Empower was an asset-based, a portion of the per head fee. I misspoke there, pardon me. Next slide, please. So you can see the illustrations here. The main thing to note with respect to these illustrations is we're starting off with the 5580, so the new TPA fee, not the existing TPA fee. And the other aspect of this is the note you see at the bottom is estimated using CSR's total participant projections for the fiscal year 21 and 22 budget. One thing to note about this plan is that the amount of accounts in the plan is growing at a pretty good clip. At the time we conducted the analysis, there were about 13,500 accounts, but the rate of growth was somewhere north of 400 accounts per month. And there's differential counts if you're looking at those that have vested or those that are inactive and a few other things that reduce the number of accounts that long-term will be present. But you should be expecting a significant growth in the total number of accounts in the upcoming fiscal year. And you can see here that the revenue raised is fairly straightforward. No charge, obviously nothing. 25%, you get 273,000. And then these are directly as multiples. You may see these look a little bit odd for the figures. This is for divisibility, so they can be charged as part of a monthly charge by Empower without having to engage in rounding, which is just easier for Empower as a counterparty. So if there are no questions for that, I will go ahead and move on to the next slide. And I'll hand it over to my colleague Tom to discuss the incidence of these fees on the various groups of people using some illustrations.
Thanks, Ben. So what we did here was looked at participant impact, and we took a low balance participant. So David here in this illustration has $329 invested in the plan. That equates to, when we looked at the data in January, a bottom quartile balance, so someone who's at the 25th percentile of plan balances. We also looked at Terrell, who's a medium balance participant. So this is someone who's at the median, so their balance is $1,019. And then a high balance, which we're categorizing as someone who's in the top quartile, so 75th percentile. That's Lori, $177 invested in the plan. And then if we say, okay, we want to have these people pay 25% of the fee. So on a pro forma basis, if David's balance is $329, if he pays 25% of this TPA fee, that equates to 4.2% of his balance. If he pays 50% of the fee, or $27.84, that's 8.5%. 75% is 12.7%. 100%, if he pays the whole $55.80, that's 17% of his $329 balance. And we do the same thing for the median balance participant and the high balance participant. And the idea is to show what's the impact for, we're looking at the low, medium, high, what's the impact to them of having to pay a quarter, a half, 3/4 of all of the fee. If we go to the next slide, and I'll pause after we get to this next one. This is our summary observations, is that per head fee is the most viable, as Ben's been talking about, as a way of assessing the fee as opposed to other structures like an asset-based fee or a hybrid. For a per head fee, if you say we want to charge the full $55.80 to the participant, if we look at the low balance participants from %15% of their balance, the full TBA. In a year, if your investment return is 17%, that's a really good year from an investment perspective. Let's say you're in the target date fund and it has a 17% year. That's a great outcome. But then you're effectively wiping out that investment gain with paying the full TBA fee. And then we look at the stratifications below that of 25, 50, 75%. What does that mean in terms of the percentage of the low, median, high balance participants in terms of the impact to their balance by each category? So I'll stop there and see if there's any questions or comments on this analysis.
Any questions? So certainly as we go through this, we have to continue to remember that at this point in time, the people who are participating in it are brand new employees. Okay, go ahead, Tom.
Yeah, exactly. Just to accentuate that, as so it's about 400 plus new participants coming in every month. But these are new employees, could be at a very low salary level, and we see that in the balances. Even what we call the high balance, the top quartile, that's a little over $2,000 because it is a young plan. So I'm going to turn it back to Sarah on the next slide.
Thanks, Tom. Thanks, Ben. If you can go to the next slide. Thanks. So this chart shows the third-party administrator fee on active and terminated employee accounts using the different scenarios that Ben already showed. A, no charge. B, 25% of the lower negotiated TPA charge. and then C, 50%, D, 75%, and then E, the full. And then it estimates the total budget in that third column that total budget impact that would be taken off the amount that's currently being charged to the employers on the per participant assessment that we use. And then I further broke out that total budget impact between what we have for active accounts. These are people currently in the plan, it's current employees, either at the Commonwealth or our other employers that are working and contributing or on leave without pay. And then the far right column are terminated accounts. And once again, this is just using static information that I used to create the 21-22 budget, so the participant projections. So before turning it over to the committee for discussion, I'd just like to flip to the next slide. So as these are all options for the committee to consider, from the status quo all the way up through the full TPA charge. No matter what the decision is, STIR staff and the investment consultant will develop a fee policy for board review and approval. This policy will set out activities and procedures designed to promote oversight, increase transparency, and review of fees. This is particularly important because of the defined contribution plan and it being in its infancy and growing, and as the population grows and becomes more established. The fee policy statement is an industry best practice. So if you go to the next slide. We did put some sample motions on board docs under item 6A. So I'll just now open it up, Mary, if you want to have a discussion.
All right. So the motions that are on board docs are discussion purposes. It's really, we can go a number of different ways here. But why don't we begin with just some discussion on what do people think about charging these participants? Oh, Mr. Philman?
Yes, thank you, Chairman. I really have a difficult time with this whole process and the defined contribution plan. We're talking about people that haven't been here for a long period of time. We're talking about people that I think it was just said at the lowest end of our pay scale. We're talking about people that have an average balance of $1,000 in their accounts at this point. I think we have to understand again that this defined contribution plan is not a pension plan. It's a savings account. I think it's really unfair if it was a problem with the legislation that we are now shifting the costs over to the member, the lowest paid member with the least amount of resources in their pension account or savings account. And I'm not disputing the presentation about the cost, the presentation about the TPA, the presentation about the fees, the presentation about the salaries, administrative costs. I just think it's, as was indicated as some option that is there, that this should be picked up by the employers or the General Assembly. I think, I know that we are having a very difficult time hiring folks off the street to come into state service. And you can just imagine a new employee under this defined contribution plan sitting next to a person with a DB plan saying, not only do I have not the plan that you have, but I'm now being charged, which I wasn't when I first got hired. So I think that at this point I am totally against any kinds of fees, as nominal as it is. Because I think the next thing that the new employee is going to think of, okay, it's at this part now, it's this percentage. Next year it's going to be something else. Next year it's going to be something else. So I am totally against making the employees pick up these fees, even if it's a industry norm. again, because they have just been hired and they're at the least part of our pay schedule. So thank you, Chairman.
Thank you very much. Any other comments or questions? Representative
This is Dan
Frankel?
Frankel. Yes. I'm in complete agreement with Chairman Philman on that. I mean, I was skeptic when we did this in the General Assembly about going to this type of retirement benefit after having a robust defined benefit plan taken away from future employees, and I completely agree, that the consequences that Dave is talking about in terms of being able to recruit people is a consequence of that. And we have generally retirement crisis throughout this country, and to take what is a fairly, meager retirement benefit and further penalize people by charging them these fees, particularly at this early stage as we're implementing the defined contribution plan, at a minimum is premature, and ultimately I don't think I'm in favor of even down the road looking at something like this. But I do believe that we ought to either go to the employers, preferably I'd like to continue the General Assembly funding the fee structure here. Thanks.
Thank you. I just want to remind you that, anyone on the board is more than welcome to speak up and ask questions or comments. Representative Schemmel?
Yes, thank you. The General Assembly moved to the defined contribution plan so that we could become more industry standard in the way we handle retirement amongst our employees. So passing on these kinds of administrative costs to individuals who own those plans is appropriate and industry standard. I certainly understand what my colleague Representative Frankel was saying, particularly in these early years. Maybe we consider a graduated movement into the administrative fees being passed along. But as that's industry standard, I think that is the appropriate thing to do. The idea the General Assembly had was to get away from expenses that might cost the Commonwealth when it comes to these retirement plans. And so I think that this is a move that we should make. Maybe we consider, as I said, a graduated proposal of 50% or 25%, increasing maybe by quarters each year for the first 4 years. I don't know, but I think that this is appropriate and this is the direction that we should go.
Thank you. Mr. Erdman.
Hi, this is more of a technical question, probably for Sarah, but what would be the mechanism for assessing the fee to the participants? Would it be something from CSRS or from Empower? How would that show up to the participant? And are there any of these options that are more administratively difficult to assess and maintain than any of the others? Thanks.
So these are just a portion of the full third-party administrator fee. And John Fallon, if you want to jump in if I'm misspeaking at all. But the way that these would be assessed from a participant's investment account at Empower is very similar to how it's done on the deferred compensation side, because they've been paying this third-party administrator fee, all along. So every month, Empower runs the fee job, and they would withhold the proportionate amount on a monthly basis from the participant's account, and then there would be transparency of that on a statement.
Okay.
I'm hoping if I'm misspeaking, somebody will.
No, Sarah, this is John Fallon. That's correct.
Okay.
Okay. Thank you. Chuck, any follow-up on that?
No, that answered my question. Thank you.
Okay, thank you. Anyone else? Okay. Some good points have been raised, but, what I continue to think about is that this is a mandatory plan, and Representative Schemmel is very much correct that the whole point of the General Assembly was to transition to this plan to reduce costs going forward and be more in line with industry standards. At the same time, the people who are on the plan currently are most likely young people, low income. I mean, the median balance of $1,077 is pretty incredibly low. And we currently have a funding mechanism. I mean, I really want to say thank you to the staff for bringing this to our attention, because I think we could just keep rolling along and never even discuss this. So kudos to the staff for bringing this to our attention. But we do have a funding mechanism. The current employer payments combined with the forfeiture cost, are currently paying for this. I guess I'm very loath, and I would like to learn more. I would like to, perhaps ask the staff to continue this analysis as the plan develops and we have more participants and the balances get larger. And that's my thought right now. Any other comments, questions? Mr. Erdman?
Yes, just kind of following up on that point. Isn't it the case that even as balances grow, so if we decide to do this in the future, and let's say it's ultimately at the full TPA fee, isn't it true that then always the newest employees will get sort of whacked with the same fee as even longer term employees who have higher balances? So does it really make the issue go away if we, wait some period of time before implementing fees?
Well, I don't want to, our consultants can perhaps answer this better, but my thought is that perhaps there could be a phased-in approach that you wouldn't charge new employees or accounts that were below a certain threshold, but I will ask the...
Right. Yeah, Mary, if I may, it's Terry. Mm-hmm. You'll see later in the next presentation that I know we're kind of coming up on we're past our closing time, but we do have another plan to look at. But in those slides, you'll see a concept that puts in like a base where one of the scenarios is that anyone under a certain amount would not have to charge the fee. So there's like a floor, like if you're under and that addresses kind of the low balance thing that you're talking about. Mm-hmm. That we could, those things can be addressed that way.
Okay.
And you'll see that demonstrated in a few more slides when we get into the deferred compensation part of the presentation.
So the staff could do some analysis and make recommendations down the road.
Exactly.
Okay. Oh, okay. Mr. Thal?
Yes, I'm not a member of the committee, but my thinking was along the line of where you were going, Mary. If the best practice is to have staff develop policies on fees, let's let that play out, and then we can always revisit this once we have more information.
Okay. Thank you. And Mr. Jordan?
Thank you, Mary. I, too, am not a member of the committee, but I just wanted to make a comment. When you think about this from a budgeting standpoint, from the Commonwealth's side of the equation, in the DB plan, they were paying and are paying, in excess of 31 or 32% of payroll for the contribution for their employees. And not that the TPA fee is the only thing they're paying for this new class of employee. But, you know, when we're talking about something like $55 annually per one of these employees, it's really not even a rounding error in what it would add to their personnel costs. So I think I have to say that you know, the impact to the employee that is in this new DC plan is pretty drastic, and the impact to the Commonwealth's budget is less than minimal. I think I have to agree with Chairman Philman and Representative Frankel that this is perhaps not the time to undertake this endeavor.
Okay. Thank you, Mr. Jordan. Is there anyone else? All right. We have some potential motions that have been drafted by staff, and one of them is a motion to continue to not charge any participant in the state employees defined contribution plan a third-party administrator fee during the 2021-22 fiscal year. Another motion would be to direct the staff of the state employees defined contribution plan to work with its investment consultant to develop a fee policy for establishing and periodically reviewing participant fees and adjusting such fees as needed, and to present the fee policy to the board in conjunction with the 23-2024 budget cycle. Okay.
Mary, this is Dan Frankel. Do we need a motion to continue the status quo? I mean, is that necessary?
I don't think it's necessary to have a motion to continue, Representative. As the executive director, what was most important to me, and I think to Sarah as well, and the rest of the staff, was that the discussion was had, and that we knew definitely where the board was headed. So I don't. The board made a motion in the fall or actually, yeah, I think it was to go with the employer charge, but we had not had the opportunity because that all happened relatively quickly. So we had not had the opportunity to go through this full analysis, but we felt that incumbent upon us to do this full analysis and give you all the information. That's what we were really trying to accomplish today. So I don't, Joe, I believe you, if you feel differently that we need a motion to continue status quo, I don't think we do. I feel satisfied having had the conversation with the board, but it wouldn't hurt, but I don't know that it's necessary.
Yeah. Sarah, did the prior motion cover the 2021-2022 year to charge the agencies, the employers, the per participant assessment? Or are you still seeking guidance on that year?
I'm not sure exactly what the per participant motion and the employer per participant charge said, but I think it was some wording to say it can be done ongoing into the future.
Okay, so we've covered for that, and by doing nothing, we do have a motion that would allow us to charge the full $292 to the agencies. If that's what the motion said, then we don't need anything now.
If you can give me a second, I might be able to find it quick.
I'm looking as well, but I'm not getting connection here. I can imagine that that wouldn't have been the case, but you know.
That would have been in July.
Let's see.
Let me go back to July.
Look. I was actually checking the website for our board motions, and I was having, there it is, let's see. officers. There's board.
The one thing the motion might provide is something to the effect of, you know, the board deliberated and came to this conclusion. I think the vote and the motion probably say all that a little more clearly, but that's my 2 cents. Take it for what it's worth.
Yes, I have it here. The motion delegated to the secretary of the board and the administrative staff the authority to determine the per participant charge to the employers and assess that to the employers. So the motion that was adopted in July covers the 21-22 fiscal year, allows the staff to make that determination, and if the board doesn't do anything affirmatively, then the staff will have the authority to exercise that delegated authority, and I would assume would conclude that everything goes to the employers.
Okay. Thank you, Joe.
Thank you, Mary.
Okay. So, a motion is in order for the Finance and Member Services Committee to recommend that the State Employees Retirement Board direct the staff of the State Employees Defined Contribution Plan to work with its investment consultant to develop a fee policy for establishing and periodically reviewing participant fees and adjusting such fees as needed, and to present the fee policy to the board in conjunction with the 2023-2024 budget cycle. May I have a motion?
Mary, Dan Frankel. So by the wording of that motion, it basically, because I'm not having it right in front of me, it sounds like we're assuming that we will impose a fee at some point.
Yeah, Mary.
Not the appropriateness of whether to have a fee. Am I right?
Mary, may I butt in for a moment? Excuse me.
Much appreciated.
There was a draft motion on board docs for no fee. There was an alternative motion to charge a fee, and I would recommend that before we jump to the motion on the policy going forward, it would be appropriate for you to ask if any board members wanted to make a motion, committee members wanted to make a motion to assess a fee.
Specifically, finance committee, finance.
Right.
All right. Thank you so much. So, does anyone want to make a motion to assess a fee for the defined contribution plan?
And there is a draft motion on board docs that you could use.
All right. Any motion? All right. Now do we move forward with a motion going forward? And Joe, I'll ask you this.
Yes, I think the motion that is on board docs does not imply that there's a current fee. It talks about developing a fee policy for establishing and periodically reviewing participant fees, which could currently be zero, and adjust the fees or not, whether they're zero or anything else, and to present that fee policy going forward. So I hear what you're saying, Representative Frankel, but I do not read the motion as implying that there's currently a fee being charged.
Okay.
Thank
you.
Thank you both.
If I could get just a clarification, so I actually would have made the motion on charging the fee, but I'm not on the finance committee. So, are all of these votes then relative to the fees only for those to be voted on only by those members of the finance committee specifically?
Correct.
But Representative, when this subject comes up in the full board, you may make a motion in the board meeting, even though the committee did not take an action on the suggested topic. So when Mary makes the motion or does her report and says the board discussed but made no motion or took no action on charging a fee, any board member could then say, but I would like to make a motion and make it for the first time at the full board meeting.
Very well. Thank you, Joe, for the clarification.
Thank you.
You're welcome.
I have a question.
Chairman.
Thank you, Chairman. And I agree with Representative Frankel. I mean, Joe, if we're just going to let it go, if we're just going to continue the status quo, why do we have to have a motion to continue with the status quo? I mean, I think when you
don't on the fee, but you're authorizing the staff to, if necessary, spend the money and consult with experts to do the further studying that Mary was talking about, or to engage in best practices that as a fiduciary you examine these issues periodically and develop a policy on the fee. That's what the second motion is about.
Well, what motion is it? Is it motion 3?
Motion 3, yes.
Well, but that says direct the staff to work with investment companies to develop a fee policy for establishing and periodically reviewing participant fees. So we're going to establish a policy under this. And I think we're saying is, at least I am, why do we have to do this now? Why can't we just have the status quo and deal with it in the future?
You could, if you wanted to. The staff.
Can I add something to try and address the Chairman Foreman's question?
Please do.
Thanks. Chairman Foreman, to clarify to your point about what would be articulated in that policy, the policy could actually state that the TPA fee, the third-party administrator fee, that $55.80 today, it could be articulated in the fee policy that that's not paid by the participant or the employer is paying it. That could actually be part of the fee policy. If a fee policy is conceptually to articulate how fees are being paid, how they're being monitored. It's not to necessarily articulate that the fee has to be charged. Does that help?
I understand what you're saying, but it continues to talk about participant fees, and I have a problem with that, even if it's developing a policy that says no fees. I think, if the motion is as it is, I have a problem with the motion, but I understand what you're saying.
Okay.
Well,
but
what if we...
your question, Chairman, the board need not authorize the staff at this time to go forward with a fee study. That authorization could occur at a future meeting, if that is what your question was.
Yeah, exactly right. If you're saying let's not take any action in a motion and lay it for future discussions, that's where I'm at. If there's going to be a motion even similar to 3, I'm going to vote against it.
Yeah, and I don't think anyone's actually made that motion yet.
I agree. I understand.
Okay. Then no motions are necessary for this committee, for this issue.
I'll make that motion. No.
And I know we are over, and we've not yet begun the next topic, but it is imperative that we continue on and get to the next topic.
Okay, thank you.
Because again, it's very different. It's very similar yet very different from this one. So you'll hear a lot of the same stuff, and I'm going to ask some of this information in the presentation and some of the background slides may be similar, and I'm going to ask staff not to or Kale not to repeat what the basic concepts that we've gone over in the previous ones, but we can't cut short and move this topic to a later date. We must proceed.
Okay, Sarah.
Okay, thank you, Mary. Can you go to the next slide? So now we're going to cover the deferred compensation plan, where we're going to concentrate on the administrative expenses. The investment management fees are covered by the participants. Unlike the plan we just spoke of, the defined contribution plan, the deferred compensation participants are paying the third-party administrator fee. And then we have these administrative expenses. They were covered through revenue allocation through our power contract of $275,000. And a fund reserve balance remaining from when participants were charged a State Employees Retirement Board administrative fee, and then interest earned on that balance. If you can go to the next slide. As you can see in that chart, the balance of the administrative expenses have been rising over the years. A few drivers of that has been in 2015, we hired an investment consultant to help us follow best practices and make sure we're getting the best investment options for our participants. 2017, the board adopted an initiative to grow the plan. Also in 2017, we elected to diversify the stable value fund. And then again in 2017, Act 5 was passed, where members received less of a guaranteed pension benefit, which makes this plan more vital to their total retirement picture. And then an interesting fact, all aspects of the plan were historically housed within the Office of Financial Management. And then over the past few years, these duties were spread out to other subject matter experts in other areas for internal efficiency and to provide better service to participants. And I'm just going to turn it over to Joe Torta quickly just to state some positives for making this change.
Yeah, thank you, Sarah, and I'll be very brief. You know, some of the examples, once we made the change, it allowed us to specialize our approach. We placed greater emphasis on the deferred compensation program, really elevating it to be comparable to both the defined benefit and the defined contribution plan, as opposed to just a supplemental optional plan, which is what it actually is. We simplified our plan identifiers, we color-coded everything, and in all of our publications, we stopped using acronyms and jargon, and we refer to simple things in simple terms, like your investment plan, your pension plan. The response from the members and participants has been very good. As I mentioned earlier today, we combined the annual statements into one document, and the overwhelming response has been positive from the Commonwealth employees regarding that. We also coordinate and combine, or we coordinate our distribution of material with their marketing campaigns. It's more unified approach. It includes both the content and the timing of the distributions from each system, and it's been very effective. And lastly, we have individual email accounts set up as portals for information for participants in each of the two plans, the hybrid plans, the defined contribution plans. We also have one set up for the defined benefit plan. So no matter what plan somebody is in, they have a portal to get to a specialist that can answer their questions quickly and easily. And I will just say and leave it with this. This morning I talked about providing tools and information as a theme. You know, I rely on the talent and energy of the communications and policy staff, Pam Heil and her staff, and they've done a tremendous job. And even though we're only building blocks here 2 years in, and we're in the infancy, we really are building solid blocks, and we're moving forward. So that's as brief as I can be, Sarah.
Okay, thank you. And then one last thing is we now do a more complete and accurate accounting of staff time, and we were able to do this because we had to implement the defined contribution plan, and we're using a similar approach to what we do there, where we allocate staff time to that plan. If you go to the next slide. The administrative costs are addressed in the enabling statute, Title 72, and the plan document. And to learn more about that, we're going to go into executive session, so I'm going to turn it over to Kathy Nolan again.
Thank you, Sarah. As Sarah said, we're going into executive session now. Under the Sunshine Act, the board is permitted to hold an executive session for any of 7 reasons listed in the statute. The topic of this executive session is the fees of the deferred compensation plan, and the Chief Counsel's Office will be advising the board on the statutory requirements for those fees and related legal issues. Holding that discussion in public would disclose attorney-client privileged information, and that is the reason the Sunshine Act permits this discussion to be held in executive session. And I will move right into the piece that I'd like to speak about.
Excuse me, before we enter into executive session,
Okay. Sarah, we are out of executive session. Please go ahead.
Okay, thank you. If you can go on to the next slide, slide 37. So consistent with what was envisioned in the enabling statute and in line with best practices, reasonable administrative fees can and should be assessed to participants so that the program can continue to properly be administered. administrative costs of running the deferred comp plan have been examined, and staff would like to present the committee with different scenarios to start charging the deferred comp plan participants an administrative fee effective July 1st, 2021 to properly fund and run the plan. Just like we talked about before, SERS, Callan, and Empower have worked together, and just to save time, hopefully Callan's back on the call and I can turn it over to them.
Hi, Sarah, I'm here. If we can move from here, see if Ben is on, but we can keep going.
Okay.
Okay, yeah, next slide, please. Next slide. Okay, so this is the current state for the 457B. This is a mature plan. It's much different than the 401A, as we've been talking about. So you can see the differences in balance. The bottom quartile balance is 6408. The median balance is about 25,000. A top quartile balance is 83,400, and the average, so different than the median, so half above or below that, the average is 76,718. So what do these numbers mean? What are the implications for any kind of administration fee structure analysis? It's that because there's a lot more dispersion between the bottom and top quartiles, and because the balances are higher in general, it gives us more flexibility modeling to consider a variety of fee structures to meet an administrative budget goal of 1.2 million. So when we were doing this analysis, that's what we're trying to solve for, is raising 1.2 million of revenue. And it is important to note that this fee is separate from the TPA fee. It's not what's called the TPA or third-party administrator fee to Empower. It's the fee for administrative budget. Okay, so if we go to the next slide. So we're looking at a number of different structures, and we can go to the slide after this to talk about it, where it's, you can keep going. Thanks. So you can go, on this slide you can see that one way of raising this is assigning a per head fee. So what does that mean? It means regardless of your balance, a $21 annual fee is charged, or 1.75 cents a month. That equates to $1.2 million. This is the simplest way of, it's just a per head fee. I think Ben has actually been waiting to be let in.
I was just let in, Tom.
Okay, great. Next slide. Ben, you want to cover this one? This is where we get into what we call an asset-based fee, and it has a cap on it. You want to cover this one, Ben?
Sure thing. So the way this will work is, this is when we start to introduce the caps and so forth. And so what this means is that we're going to charge a percentage of assets to generate the fees, but we're going to cap after a certain amount of fees have been assessed from a participant account, after which point during that year, you can set it up under whatever interval you want, calendar year, fiscal year, however it's most preferred, but you'll cap it on that basis. And Empower does have this capability. All the items we've discussed, we have verified with Empower, and I will trust that the folks in Empower will speak up if I in any way misspeak as to the capabilities. So what this ultimately will produce is, again, this target range of 1.2 million that we're looking for with various combinations. I would like to highlight just a couple of quick items here. You can see the first is 3 1/4 basis point, so 0.0325%. And a $100 annual cap is going to get you to the point of 1.201 million, so almost exactly. You can see that there's not a lot of variation in terms of the trade-off between the caps and the basis points. Also, the basis points get you there pretty quickly at a low basis point level, so small changes in the asset-based fee equates to fairly large changes in the cap there for the revenue. So if you go down to 3 basis points, so 1/4 of 1 basis point in terms of the change, you can raise the cap to $125 and get just slightly under the $1.2 million target at 1.188. And again, these are January asset levels, so the market has moved up a little bit. So if we ran these numbers again today, this would likely be a little bit over, just to be clear. And then 3 basis points, $150 annual cap, so a $25 move in the cap
Yeah, I think we can go through a couple of examples, Ben. to help illustrate how it impacts participants?
Absolutely.
Okay. Okay, great. So if we go to the next slide, oh, there's a question. Please go ahead.
Thanks, Tom. I just wondered if you guys have done any analysis as to how these various fee levels lay out across the participants. You know, for somebody with, you know, a $300,000 or $400,000 balance, you know, versus somebody that's at the average or at the median, you know, how does it lay out as far as who's paying what? Do you know?
Yeah, we're actually about to get right into that to try and get that. Yeah.
Okay. I'm sorry.
No problem. Thank you for the question. So if we go to the next slide, to Greg's question, this is showing different impacts. So Greg's question is more directly, and this one, it's looking at two participants. So as Ben was talking about, we have this idea of the floor, and we also have a cap at the top end. So in these two instances, there's people that are affected differently. One is Bonnie. So Bonnie is below the floor of $5,000. She has only $2,000 invested in the DCP. That means that Bonnie's not paying because she's under that $5,000 floor. Hector is at the high end. So Hector has $300,000 invested in the DCP. So that means he's above the 5,000 floor. So when we think about that per head fee, $1 a month equating to $12 annually, he's paying that. He's also paying an asset-based fee. That asset-based fee is capped at $50. So there's a ceiling on that fee. It's 2 basis points, but only up to $50. So in total, Hector's paying $62. If there was no cap, he'd be paying a little bit more. It would equate to $60 on the asset-based fee. So in total, he's paying $62. And what does that equate to of his balance? It's 0.02% of his balance. So it's a very balance, and it's capped. If we go to the next slide, this is getting more into what we talked about with the 401A. We were showing more extreme examples, someone with a low balance, Bonnie and Hector, who had a very high balance. Here we're showing these are people that are at the low balance. What do we mean by low? This is someone who's in that bottom quartile, so the 25th percentile balance, that's $6,408. Someone who's at the median or median balance, that's Terrell, he's at $25,413. And the high balance, Lori, she has a top quartile balance. That equates to $83,400 when we got this participant data in January. So all of these people are above the $5,000 floor. So they all pay $1 a month, assuming they keep their balances above $5,000 throughout the year. That equates to $12 in the year. Then their asset-based fee, though, is going to vary. You can see that in that asset-based fee column. So David, he's just barely above the threshold. So he's paying an asset-based fee of only $1.28 to 2 basis points on his balance. So his total annual fee is $13.28. That's 0.2% of his balance. If you look at Terrell in the middle, he's paying $5.08, total of $17.08. And this is an even smaller percentage of his balance, 0.07%. And then Lori, that's our high balance participant, she's paying a total of $28 between her $12 per head fee and then her asset-based percentage. So it's a total of $28.68, and that's 0.03% of Lori's balance. So if you think back to what we looked at for the 401A, where David at the low balance there, it was a different amount, but that was equating to that $55.80. Paying the whole thing was 17% of his balance. We're talking about numbers here on a percent of the balance basis are much lower. So this is much less onerous to the participant. If we go to the next slide, and this is the last slide we wanted to cover from a calendar perspective is we looked at all these different options, the per head fee, the asset-based fee where you put a cap on it, like Ben was talking about, let's say $100 was one of them we looked at. Bounded asset-based fees with caps, so you could say we're going to not have participants below a certain balance pay anything at the high end, and then the last set of examples that we just looked at, and that is this hybrid asset-based fee. So you have participants that are with low balances at below 5,000, they don't pay. And then at the highest end, the fee at a relatively low level of $62 for the participants with the highest balances. Now, there are some advantages to this hybrid asset-based structure we've just been going through because you're accounting for those with the low balances and you're also capping people with the higher balances. But this is more complex to administer. As Ben said, we have confirmed that Empower can do this type of calculation and would be done monthly. It does require ongoing monitoring, though, because it's not just about Empower doing the calculation. It's also what happens with participant activity, participants putting money in the plan, taking money out, what happens in the markets, so how markets move and how that affects balances. And it does require ongoing monitoring. So typically in a case like this, a client that we work with would be looking at this at least every quarter. So do they know, are they on track to meet the budget requirement? And finally, fee, right? This is an administrative budget fee that we're trying to achieve of that 1.2 million. And I'll stop there. Ben, would you add anything?
Yeah, I would just add that, everything requires ongoing monitoring to some degree. But one of the advantages that I wanted to just reemphasize, and to be clear, I'm agreeing with you, Tom, and also saying let's reemphasize the fact that the introduction of the $1 monthly charge here means that while you're monitoring it, you're also going to have about half of the revenue be significantly more reliable and predictable. So from a budgetary and planning standpoint, this is the least volatile of those that maintain an asset-based fee. And for those who are kind of trying to do the math really quick, this means that this is bounded. If you have a balance between $5,000 and $250,000, that's the boundary. And then beyond that, you'll have a clear sense of either no fee or no additional fee. So that's how the math works out there. So there are not that many participants that are on either side of those two boundary points. And those are the ones that will be the bigger outliers mathematically.
Great, thanks, Ben. I think we have a question from Greg Jordan.
Go ahead, Greg.
Thank you. If we were to go with one of these more complex approaches where you say, it's more difficult for Empower to, do the record keeping and stuff, does that result in the third-party administrator fee going up at some point in time?
So this is John Cohen, and that is no. The answer to that is no.
Okay, thank you.
Mm-hmm.
Any more questions for the Callan team? Okay. Sarah, are you back up?
Thank you, Chair Serber.
Thank you.
Thank you.
Thank you, Tom. Thank you, Ben. So can you go to the next slide? And the next one. So based on the analysis performed, the following fee structure is recommended for charging deferred compensation plan participants an administrative fee in addition to the TPA fee that they're currently paying. So as Callan just mentioned, this hybrid bounded asset-based fee with a cap is, one of their preferred options. It's also, a recommended option for, all the SERS staff that worked on this project as well. So this would be where a participant with an account balance over the floor of $5,000 will be charged a hard dollar fee of $1 per month for $12 annually, and an asset-based fee of 2 basis points, which will be capped at $50 a year. And then also, based on the recent TPA fee reduction that we mentioned from Empower, it's also recommended that these savings be passed down to deferred comp plan participants, the current TPA fee of $59.50 will be $55.80 or $465 a month, effective July 1st, 2021.
Okay.
If you go to the next slide. So no matter what is decided, the same thing here, we would like to work on, whether there's a motion or not, internally, developing some sort of fee policy. This is particularly important for this plan, for the deferred comp plan, so we don't go so long without a proper review and analysis of looking at the impacts of potential administrative fee assessment and, continually monitoring it to remain sure that it remains reasonable over time and looking at our cash flows. And once again, we believe a fee policy statement is, best practice in the industry. So if you can go to the next slide. So there's potential sample motions, once again, filed under the executive content in agenda item 6B in the Finance and Member Services board docs.
Okay.
And Mary, I think you have a copy of those.
Yes. So any discussion or any more questions on the recommended fee proposal for the deferred compensation plan? Mr. Erdman?
Yes, Sarah, so our administrative costs per participant, are they variable or fixed? Does it matter whether a participant has a higher balance or lower balance? Does that impact our actual administrative fees that we're trying to cover?
From the internal purposes here at CSRS, from doing the work, in my opinion, in the finance perspective, I don't know that there's a difference in, the work that we perform for a higher dollar value person or a lower dollar value person. We see the work is the work. A lot of times in my area, the finance area, we're processing batches of items like contribution payments. Am I answering your question?
Yes, you are.
Okay.
So I guess my follow-up question would be then, so if we pass some fee structure which charges higher balance participants a higher fee when the work is really the same for all participants, does that create any sort of equity issue between participants, and maybe the lawyers want to weigh in as far as any fiduciary responsibilities here between participants in the deferred comp plan, if we should be charging them a different fee when our cost of administering their accounts isn't any different.
I don't know if someone from Callan can weigh in, or legal.
Yeah.
Maybe Callan
We
first.
could hear from prevalence. Maybe we could hear prevalence from Callan, and then I think then legal could weigh in. If Callan could talk about is it something that is common and reasonable, or in the industry?
Yeah, go ahead, Ben.
Absolutely. Yeah, so it's common. I think the extent to which it is done and how it is done is dependent on the structure. For plans that are structured as you are, where you have a combined entity that particularly will work on both DB and DC and so forth, it is exceedingly common to have an allocation to cover the associated costs for the defined contribution plan, and we work with a number of your state plan peers that have exactly those sorts of charges. The key distinction is to try to get a metric of the time and to make that, and the cost allocation, and to make that reliable and something that you can track over time. But beyond that, it is quite common. And if you were to look at kind of an ERISA frame, you would view those costs as qualified plan expenses, which are routinely charged for across the industry as a component of baseline administration. In terms of their variability, it very rarely costs more other than from a liability standpoint with larger or smaller dollar amounts. And so those costs are fairly reliable and not particularly related to the total asset volume, except insofar as the asset volume corresponds to the number of participants and the infrastructure required to support the plan.
But what is your understanding of charging higher balance participants a higher fee if the level of service is the same? I think that's what Mr. Urban was trying to get at.
Oh, if I misunderstood the question, my apologies. Thank you for clarifying, Terry. So it certainly is the case that you can charge certain participants a higher amount because to some degree there are asset-based fee charges. And at the same time, plans go through things like an evolution where you might have had an asset-based fee charge at some point in time, and if you switch to a hard dollar fee charge, then someone may have benefited from the asset-based fee charge when they were earlier in their saving career and then have a higher balance to be benefiting on the back end by not paying what would otherwise have been the corresponding life cycle cost. So to that extent, you see occasionally plans that do that, but for the most part, the ways in which people who are getting additional benefits pay a higher amount other than through an asset-based fee is just if they consume ancillary services. So if you have per participant fees associated with things like managed account uses, financial planning advice, things like that. But broadly speaking, you don't tend to see fees other than in this kind of hybrid structure where you intend to put a greater burden on the higher balance participants, except insofar as you have an asset-based fee structure.
Yeah, and I would just add to that, Terry, that if you had, let's say you have the per head fee, you go with the simple 21, right, that we've looked at. It depends on how you look at it, because if it's 21 and I'm David and I have a little over 6,000 in the plan, let's just say that's a newer participant who's had less time to save money in the plan. That's more punitive to them on a basis point level than it is Lori, who's at 83,000, I believe it was, and is paying 21 on 83,000. So Ben and I have gone over this in different staff meetings, but for the board's edification, what that means is there's really no right answer in that sense, where one is fair and one is not. Would you add anything to that, Ben?
No, we have no metric for fairness. We only have metrics for incidence, and we have metrics for prevalence. And I can say from a prevalence standpoint, just to agree with what you're saying there, Tom, I think it's very common that your peer plans across the country, particularly at the larger institutional level, have a sensitivity towards making it clear to people who are beginning their saving career that they're doing the right thing and to provide incentives to do that. Similarly, there's a sensitivity to placing whatever someone thinks as an undue burden on the higher balance participants because they don't want to do what some might term penalizing doing the right thing or being successful. Where within those boundaries of positions the right answer falls is in the eye of those who assess things that are like fairness as opposed to mechanics, feasibility, and so forth. We can speak to mechanics, feasibility, and prevalence. I can say that some boundary like that is very common. We work with a number of state plans that do exactly something like what we've talked about here. But where you should place the target, we can't opine on that.
Anything more, Chuck?
Terry,
No?
I would just add the plan document does give the plan administrator direction and authority to make all necessary and reasonable charges. So for all the reasons that the Callan team has articulated, I think we could argue that they are reasonable. It's, there's not specific authority, but I think that supports, a thoughtful, balanced approach.
Okay. Thank you. Chairman Philman.
Yes, my position with this is different than for the defined contribution. I think that, and I agree with what Charles is saying, the flat fee versus what. But I think there's, for one thing, it's not a mandatory plan. This is a voluntary plan. And the fact that we have a ceiling and a floor with that, I have no problems with that. And I agree with the concept that we're trying to get folks involved with it. There is obviously the savings for the TPA costs that drop, but also there's tax-deferred savings for everybody. And the only thing I have now as a comment is quite a few years ago, out of the Treasury office, there was some concern about getting folks more involved with our DC plan, deferred compensation plan. And I'm just hoping, and again, this is a comment, I'm just hoping this doesn't have a chilling effect on folks that will not get more involved where we were pushing on ourselves, but empower to bring more folks into the DC plan. So I agree with the staff's recommendation as well. So thank you, Chairman.
Okay, thank you. Any more questions, comments, discussion? Okay. I'm going to proceed with the suggested motion, number 1. A motion is in order for the Finance and Member Services Committee to recommend that the State Employees Retirement Board, as authorized by Section 4521.2 of the Fiscal Code, 1, reduce the current monthly third-party administrative fee for the participants of the Deferred Compensation Plan from $4.95 to $4.65, effective July 1, 2021. Number 2, assess all participants of the Deferred Compensation Plan whose account balance exceeds $5,000 a separate fee for board expenses to administer the Deferred Compensation Plan, consisting of A, a monthly flat fee of $1, plus B, an annual asset-based fee calculated as 2 basis points of the account value and not to exceed $50 annually, with both the flat fee and the appropriate portion of the asset-based fee to be withheld on a monthly basis from individual investment accounts effective July 1, 2021. May I have a motion?
So moved.
Second. It's Frankel.
Okay, Mary, I'll do the roll call voting.
Thank you.
Mr. Erdman, on behalf of Senator DeSanto.
Aye.
Chairman Philman.
Aye.
Committee Chair Soderberg.
Aye.
Representative Frankel, sorry I missed you.
Aye.
And then a designee for Secretary Begg. Unless he's on the call now?
This is Alan. Aye.
Alan? Okay, thank you. Okay, we have 5 yes votes.
Thank you. The motion carries. Motion number 2, a motion is in order for the Finance and Member Services Committee to recommend that the State Employees Retirement Board direct the staff of the Deferred Compensation Plan to draft proposed conforming amendments to the 5th amended and restated Deferred Compensation Plan for officers and employees of the Commonwealth of Pennsylvania document, and the 3rd amended and restated Trust Declaration for the Deferred Compensation Plan for officers and employees of the Commonwealth of Pennsylvania document, to reflect the board's decision to charge participants the approved fees for board expenses, and to present the proposed amendments to the board at its June 2021 meeting. May I have a motion, please?
So moved. Second.
Roll call, please, Sarah.
Mr. Erdman, on behalf of Senator DeSanto.
Aye.
Chairman Philman.
Aye.
Representative Frankel.
Aye.
Committee Chair Soderberg.
Aye.
And then Mr. Flanagan, on behalf of Secretary Begg.
Aye.
Okay. 5 yes votes.
Okay. There is a third motion that the staff has recommended, and that is that staff develop a fee policy for the Deferred Compensation Plan. Before I make that motion, any discussion?
Just a clarification, Mary, what does that mean in interest to the first motion we made?
This would be for the deferred compensation plan so that the fees that we have set today or proposed setting today would be reevaluated on a regular basis.
Okay.
Staff, any other comments, staff?
No, it's just very important because we went so long without evaluating these fees just to get something formalized so we can keep monitoring it and bring it back to the committee and the board for discussion purposes. So like Tom said, this would look to create more transparency and monitoring of the fees. This plan is a little bit different than the defined contribution plan.
Mm-hmm. Okay. Motion number 3. A motion is in order for the Finance and Member Services Committee to recommend that the State Employees Retirement Board direct the staff of the Deferred Compensation Plan to work with its investment consultant to develop a proposed fee policy for establishing and periodically reviewing fees and adjusting such fees as needed, and to present the proposed fee policy to the board in conjunction with the 2023-2024 budget cycle. May I have a motion?
So moved.
Second?
Second.
Thank you. Sarah?
Mr. Erdman, on behalf of Senator DeSanto.
Aye.
Chairman Philman.
Aye.
Representative Frankel.
Aye.
Committee Chair Soderberg.
Aye.
And Mr. Flanagan on behalf of Secretary Begg.
Aye.
5 yes votes.
The motion carries.
Okay. And then right now we're behind, but if you could just flip to the next slide, just so everybody the one right before. So yeah, so the next steps, just because we're changing fees, CERS is going to work with Empower to make these fee changes, and all of the participants will be notified in advance of any fee changes taking place. So I just wanted to mention that before we conclude.
All right.
So, and I do just want to thank, the CERS team that worked on this, also Callan and Empower. This was a very big and complex project, as you all know. And I also want to thank the Finance and Member Services Committee, the Defined Contribution Committee, and all the other board members and designees that sat in on these discussions. They're very important, and I really appreciate your time.
Thank you, and we appreciate the time of all the staff that have gone into this very complex process. All right, with that, are there any other comments, concerns, questions? All right, may I have a motion to adjourn the Finance and Member Services Committee?
So moved.
Second?
Second.
All those in favor say aye.
Aye.
Aye. Okay. May I have a motion to adjourn the Defined Contribution Committee?
So moved.
Second?
Second.
All those in favor say aye.
Aye.
The joint meeting of the Finance and Member Services Committee and the Defined Contributions Committee is adjourned. Thank you very much.